Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing SolarEdge's stock so we can determine if it's a buy or a sell. SolarEdge develops and sells solar inverters for energy generation software, battery storage products, and other products and services. It has residential, commercial, and industrial customers. It is the first company to successfully commercialize power optimizers, a device that feeds into the central inverter. The company is headquartered in Herzliya, Israel, and was founded in 2006. Let's get started with the model. This is a large cap company, 16 billion market cap. They're trading at $2.90 a share, and they have 56 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They didn't have that much free cash flow. It was highest in 2019 at 186 million, negative in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty steady from 2019 to 2021, dropping in 2022 to 94 million. Revenue is a sales for the company, and that does double from 2019 to 2022. They did recently release their first quarter earnings. When I went to their website, it was down, so I couldn't pull the actual income statement. This is from Yahoo Finance, which should be the same anyways. So it looks like they had their best revenue in the first quarter, 940 million. When you compare that to the first quarter of 2022, it's up about 50%. It's up about 7% or so from the fourth quarter of 2022. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That was also highest ever at 300 million. Then you have your operating expenses like marketing and R&D. Then below that is their operating income, which almost equals their prior 4 quarters combined. So they had a great first quarter. They received 24 million of interest on their investments. They don't have too much debt, so they receive more interest on their investments than they pay on their debt. That's why they had a cash inflow in the first quarter of 24 million. In the fourth quarter, it was 56 million. Their net income in the first quarter is 138 million, which is a lot higher than the prior 4 quarters combined. Let's look at the capital structure. 2.2 billion of equity, 700 million of debt. They're 75% equity, 25% debt. They could pay off all the debt with the cash on their balance sheet instead of 300 million of cash left over. I gave them a whack of 13.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 20 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $16 billion. We divide that by 56 million shares. And we get a calculated stock price pretty much exactly where they're trading at. This might be the closest my model has ever come to the actual stock price. So it does appear it's trading at intrinsic value. Simply Wall Street values them at 166. They say they're 77% overvalued. 19 analysts priced this stock, and the average price target is 379. The lowest 310, the highest 452. Another 29 analysts priced this stock, and the average price target is 368. They say it's 26% undervalued. This is where they've been trading since they IPO'd. For the first year, the stock did decline, but then it came back to where it was trading at IPO price. So the price didn't really budge the first year. It went down, then back up to where it was trading. It did hit $150 a share right before the crash in March 2020. Then it fell to about $70. But like most solar stocks, it's done really well the past couple of years. The stock went from about 70 to over 350. It did break through $350 at the very end of 2021 and mid-2022. But it's pretty much been trading between 250 and 300 for the past year and a half. It did drop below 200 in the third quarter of 2022, but it jumped up real fast from there, sitting around $300 right now. There are 20 companies in the same industry as SolarEdge. If they have a number in red, they're worse than the median. A number in blue, they're better than the median. They don't spend too much on CapEx, only 169 million. They have a good debt to equity ratio, 0.3. The average is 2.2. Median is 1.3. No one in this industry pays a dividend. Most companies have negative free cash flow. They rank third in market cap. Their price to book is a little bit worse than average. Price to sales is a bit worse than average, a lot worse than the median. Their PE is about 160. I cap it at 100 on my spreadsheet, so the average doesn't get too high. And we can't look at their price to free cash flow since they have negative free cash flow. But the reason the stock has done so well is because their 5-year annual revenue growth rate is 39%. So they are growing their revenue really well. So to summarize, I have them trading exactly at intrinsic value. The company has been around 17 years. Their revenue has doubled since 2019. So it seems like most signs point to a buy. I rank their free cash flows 1 out of 10, their revenue 7 out of 10, and their ratios 2 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to support the channel, you could click on the link in the description below. Thanks for watching.